SMSF is a great vehicle for the right people to invest in property. Obviously, there's tax benefits, there's sort of deposit, you've got those ongoing contributions. And you're right, we have a lot of people reaching out, thinking of that as their vehicle of choice, particularly people that are closing on to retirement and they're starting to look at, well, how do I generate that passive income so I can retire comfortably? The demand is understandable. The asset itself is interesting to SMSF, and that's obvious enough. The good news is that there is lending available to SMSF to purchase co-living properties. So that's kind of the end of the conversation. The SMSF can go and purchase one of those properties. The constraint or the challenge is that under the CIS Act, the SMSF cannot change the nature of an asset that's leveraged with a loan, an LRBA in this instance. So what that means in practical terms is that the SMSF can't purchase land with a loan and then turn it into a house. So you can't have a construction loan for an SMSF. That's not specific to co-living, but it is quite relevant because if you're looking at a traditional house, there's plenty of traditional houses that have been completed that an SMSF can go and purchase. So it's not a huge limitation when you're looking at traditional. When you're looking at co-living, there are very few people that are willing to part ways with their co-living properties for good reasons. They've got a great asset in a great location that's turning 10% or more rental yield, and they're not particularly keen to sell. So the supply of completed leased co-living properties, which is what the SMSF need, is very tight. As in every situation where you have a lot of demand and you have a very limited supply, it affects the price. So we've discussed through the previous episode how you've got a range of rental yield that you would expect from a co-living property, and those, for instance, can go up to north of 11% for a 9-bedroom house. The same house, if you purchase it completed, tenanted as an SMSF, typically you're going to buy around that sort of 8% yield. So you're going to pay a substantial premium for the privilege of owning that house. There are providers on the market, typically denominated around the one contract service. It's a bit of the Wild West, to be honest, but there are third parties that will potentially offer to build what the SMSF wants to build, and then for the SMSF to purchase the finished product from them at the end. There are a number of concerns regarding those operators without being specific to one or the other, but the model is under scrutiny from a compliance perspective. They require very high deposits to be paid. There's unknown sort of quantities around finance at the end as to whether you're going to be able to secure it or not. So the amount of risk is relatively high. The cost is typically very high, and the outcome is somewhat uncertain. So it's a solution. It's not ideal. It can make sense, and some people are using it, but it's in the shades of grey. So we've got the option of waiting and hoping for a completed property to turn up. And I know you facilitate those transactions, and I know you do a few every month, but the demand is way in excess of that. So it puts people on a waiting sort of setting for a period of time, and then they end up paying that premium because it's a completed property. They can use the one contract model. It comes with a tremendous amount of limitations, including locations, the type of builder you can work with, et cetera, et cetera. It's far from ideal, but I suppose it can be done. So we found ourselves in that sort of predicament, and it is complex because then concessions have to be made one way or the other to make things work. So we've been working very hard on a model that would allow an SMSF trustee to build the co-living dwelling themselves out of super compliantly, and then be able to move that dwelling, transfer that dwelling, get the SMSF to purchase that dwelling from them. There's some very specific rules around doing that. You can't do that with a traditional residential property. So we have to make sure that that model is genuinely turning the property into a commercial property to allow that transfer to be done at the end. When that's delivered successfully, what that does is that you bypass the third party, whether it's the one contract or whether it's the vendor that's built and tenanted the property. If the trustees can do that job, then the premium that would have otherwise gone to a third party is now no longer in the picture. And the outcome is much, much stronger. It's complex and it's delicate, but a solution is transpiring from all the efforts that we've put into this. I would say that if someone finds themselves in that situation where they have the ability to build on behalf of their self-managed super fund, with the view of eventually transferring that property into the self-managed super fund, they should reach out, because it's a complex conversation, but that complexity and that initial amount of effort could be worth hundreds of thousands of dollars.
You're essentially cutting out the middlemen that are providing that service at the moment.
Yeah, I firmly believe, and that's, again, work that we've done with legal specialists, with accountants, with auditors. So there's a lot of work that's gone into this, and we're now reaching a place where we are confident that there is a solution if things are implemented in the right way. I'd love to be able to share that with in great details with people who have the right sort of circumstances and are interested. It's beyond what we can cover during a podcast like this one, but this is essentially the landscape. So if SMSFs are interested, they can look for an established property. This works really well. They're going to get an 8%-ish yield from that particular investment, which in most cases is still very attractive and very palatable. They're going to get lending. There's no issue. They can look at a one contract provider and see if it can be made to work despite of the constraints that apply to that particular model. Or if they're willing to undertake a much more complex project and demanding project, there is the possibility for them to become the developer for that particular property and then to sell it to their self-managed super fund. That can be done. It's hard work, but it can be done, and the rewards are very substantial.
Yeah, and I guess that's what makes it a compelling investment for an SMSF, really. Having the numbers without a third-party company really, making a profit on your way in.
Yeah. Yep. Look, if you look at it, maybe in its simplest expression, and you get that 8% yield, I'm talking to people that are sort of either retired or on their way to retirement on a regular basis. The self-managed super fund or superannuation in general for people who have retired, and again, depending on their circumstances, but the tax on the income from the property can be as low as 0%, depending on their circumstances. So if you're looking at sustaining yourself in retirement, owning a property such as one of those co-living properties that's fully paid off in your self-managed super fund, you could very comfortably derive $60,000 clear of income for every $1 million that you've put into this. That's without any complications. That's literally buying a dwelling at 8%, paying for the associated cost with that dwelling, which might eat away, 2% of that 8%. And then you're left with a very comfortable amount of recurring income from that $1 million that you've invested. So at 8%.
And an asset there.
And an asset that's growing in value. So from a legacy perspective, the kids, whatever the case may be, there's a very strong case, which is why those transactions happen all the time, which is why you have a waiting list of self-managed super fund waiting for those opportunities.
We don't have the properties.
It makes perfect sense. Right, so that's the entry point, and it makes sense for a lot of people within their strategy because they want the income, they don't want to eat into the capital, and they want the asset to keep appreciating for the next generation. Perfect, and that can be done, and it's a bit of a wait, but it's happening. It can be financed. Everything works. For people who have a slightly more ambitious take on the matter, there are more complex solutions that will deliver maybe 10 or 11% for the SMSF versus the 8% that you can achieve through the simpler way. It's not for everybody, but for the right people with the right circumstances and level of sophistication and the right tolerance for risk, then that could work really well. So it's an interesting space. It's complex. It's heavily regulated. So we always suggest that people get professional advice, and that is not from us, but from their from their accountants, from their auditors, from their legal team, when you're putting a structure like this in place, you want to make sure you tick all the boxes and that you've got it right. But the rewards can be very, very attractive for sure.
Well, I think it might be helpful maybe to answer some frequently asked questions that come with the SMSF item, without going into the territory of giving financial advice, of course. So
please,
I guess something people are really interested in, obviously it sits in that self-managed super fund environment before the clients retire and it's taxed a certain way. What exactly happens when the clients retire?
Okay. So again, depending on the size of the superannuation pool in general. So again, there's going to be variations between clients and whatever the case may be. But I think the outcome that drives a lot of people to look into this is that for probably the majority of Australians, the transition into a retirement phase for their superannuation would trigger a 0% tax rate on the income, which is very attractive. So you have a property that has a high potential for depreciations during the years where the super is due to pay that 15% tax. So you can actually depreciate a lot of the income, a lot of things that are going to offset the income from that property, which means that, if you have a property that's, I'm being very simplistic, but if you have a property that's got a 10% yield at the start and you have enough depreciation so that not much of that particular income is lost in tax, and you're starting from a low tax rate in the first place, then realistically, you can, certainly with contributions, you can pay that property off within 8 years, 7 years, whatever your, depending on your contributions and the level of leverage that you use in the first place. So when we're talking to people in their mid to late 50s, they have a realistic prospect of purchasing that property with a deposit that they put down, maybe 30%, 20% of the value of the property, and to pay it off before they retire. Then what they're looking at is that they hit that retirement phase where for some of them, the income will be completely tax-free from the property. The property is fully paid off. So if it was $1.5 million, 9-bedroom, for the sake of round figures, it was making a 10% yield. So there's $150,000 of income coming in. You might find yourself with, $30,000 to even $40,000 of cost in running that property. You're left with $110,000, which is not taxable, which you can comfortably live from because you're not touching the capital.
And that's in today's dollars. All
that's
these
in today's
dollars.
That's in today's dollars.
Retirement.
It's fairly inflation proof because rent tends to go up with inflation. It's fully preserving their capital, and it's something that they can leverage in their early to mid 50s, pay off by the time they retire, and they find themselves with retirement income which is far in excess of most Australians. So it's simple. It's easy to understand because we're relying on sort of fundamentals that most people have been exposed to through their lives, as in property investment in Australia is the national sport, as you know. And it's a really simple strategy. Again, it's, everybody needs to look at their own circumstances, speak to their own advisors and whatever the case may be, but it's not unrealistic for someone in that bracket to look at generating, $100,000 to $120,000, $130,000 in retirement income from the one purchase of, say, $1.5 million co-living property that would have required the superannuation potentially to put down, $400,000 deposit, $450,000 deposit. These are really rough numbers, but it's achievable. If you look at sort of what that money would typically deliver to them in retirement, if they did the traditional sort of investment that superannuations do, it wouldn't come close. It's not for everyone, but some people are very attracted to that particular set of numbers.
And again, a lot of people, when they do invest in property for their retirement within their SMSF, usually when they get to retirement, that income is nowhere near enough to sustain.
No, they have to sell.
So they have to sell the property.
That's right. And then you start to eat into the capital. They have to reinvest. There's a number of considerations. So it's a very attractive solution. And I think between you and me, what we're experiencing is that I would say more than half of the inquiries that I deal with, or people that come to us for assistance with those strategies, would be people who are in that stage where they're starting to seriously look at retirement. I'd say 50 plus.
Mhm.
They go like, well, I want to make sure I can retire at 60. I don't want my lifestyle to change dramatically, so I need to replace my income pretty much in full. Certainly my net income, I want to replace that in full. And that's the way I'm going. And that's the way I'm going to do it, right? And that makes perfect sense.
It's an interesting trend I've noticed as well with the clients I'm working with. Actually, dealing with a few clients that are in retirement, and they've got a massive asset base, but they're just not getting the income, and they're reluctant to sell their properties because they don't want to eat away at the money. So what they're looking at doing is selling down some of their portfolio and reinvesting into co-living to help them have a good lifestyle throughout retirement.
It makes perfect sense. I mean, it's not a myth. The boomer that's asset rich and cash poor. You know, we've got millionaires that are living from pension check to pension check.
Yeah,
which is a very bizarre situation.
It'd be hard to explain in a lot of places in the world, actually.
So if you convert some of those assets into a different asset, which is yielding, 8, 9, 10, 11%, then all of a sudden the cash situation changes quite dramatically. And with that, the lifestyle and, how they enjoy their sort of twilight.
I guess for people looking or considering SMSF, they might not have one yet, or they're considering it because their super's got to a certain level. Maybe we could break down and help them understand, how the tax is calculated before they retire as well, and why it is such a favorable tax environment.
Yeah, I'll start at the end with that one, and I'll stress again that if people are in that stage where they're entertaining the prospect of a self-made super fund, the absolute non-negotiable from where I see it is for them to seek professional advice.
And this is not financial advice.
No, and that's not something we can do for them. So if you are thinking about an SMSF, which is fair enough, it's not for everyone, but it's very suited to some. You definitely need to speak to a professional so you can get advice and see if this is the right thing for you. The self-made super fund itself will not be taxed any differently than your CBAS or your Australian super. So the taxation regime for superannuation applies to industry super, retail super, and self-made super fund alike. So moving your money from one to the other is not going to change how it's being taxed. So typically superannuation as a whole has two different tax regimes. One apply while you're working, which is typically referred to as the accumulation phase. And then a specific set of tax rules apply to the next stage, which is the retirement phase, when you've stopped working and you're no longer contributing into the superannuation. So for the better part of your life, you contribute, it's the accumulation. And then during the later years of your life, you basically start to draw, and this is the retirement phase. The tax that will apply to your superannuation will change from one to the next. Now, what's been introduced in recent years by the current government is that they are also, it's somewhat means tested, or it's balance tested. So there are thresholds that if you reach them, typically in between all the members of a self-made super fund, and your asset pool goes over a certain amount, then the way you're going to be taxed over that amount is going to change. We won't get into specifics. As we said, we're not financial advisors, we're not accountants, but for the vast majority of people listening, what happens is that during the accumulation phase of their life, when they're contributing money into super, those contributions are taxed at the super level at 15%. For a lot of people, that's a lot less than what they're being taxed in their personal capacity. If you're a high income earner and you levy this and levy that, you end up paying 47% on your top dollars, but you instead redirect them into superannuation, then you're going to be saving, over 30% tax on each dollar that goes into super, because the super will only pay 15%. Hence the incentive to salary sacrifice and redirect money towards superannuation during the accumulation phase. The more you earn, the more attractive it is to redirect some of that income. I think that's a fairly general statement that's well accepted. Again, there are caps into how much you can redirect, so it's not, it's not the answer to all your taxation sort of planning queries, but it's certainly part of a lot of people's strategies, certainly at the high end of the income brackets. when you move into retirement, assuming you don't hit those thresholds that we referred before in terms of how much you've accumulated, then the income that's generated by your investments, which again in the previous phase, they tax what you contribute and then they also tax what you earn at 15%. When you move into retirement, what you will find is that, again, for most people that don't hit the highest thresholds, the tax is 0%. There's no tax. There's no tax on the income that you generate from those investments. If you were to sell and make some capital gains, there's no tax, which is obviously very appealing. The idea is to try to get people to contribute more during the accumulation stages because they save tax in doing so. And then they can then enjoy the fruits of their labor and they don't fall back on the pension and cost the government, etc. This is essentially how the system is designed. That's why the incentives are there. And at a very high level, this is how it works. Interesting fact, which sometimes is not fully understood, your self-managed super would technically be able to claim depreciation, i.e. negative gear, the same way that you would as an individual. So if a property is generating a positive cash flow of $50,000, you've put down a good deposit, but you've taken out a loan on your co-living property, the net outcome of the investment is that there's $50,000 left at the end of the year. Before you pay your 15% tax on that $50,000, your super typically will be able to apply the same depreciations that you would if you were the owner of that property. So you're going to be able to depreciate the building, the features and fittings inside the house, etc. So your effective tax rate, if you have a property in the SMSF, is likely to drop below that 15% mark because you're going to be able to remove some money out of that amount before the 15% tax rate kicks in, which is something sometimes is not fully understood. But that's essentially at a really, really high level, that's sort of how it works.
And another frequently asked question around SMSF, and maybe this will work best as a hypothetical, but say I needed $500,000 in my SMSF to make an investment. I only have 200 in there, but I've got 300 in my personal name that I want to put in there. What are the implications of me putting that in there?
Okay. So again, that will come down to specific circumstances. We can look at it really conceptually at a high level. So there's a couple of mechanisms that apply here. So you have what's called concessional contributions, which are your pre-tax contributions. So you're not being taxed on that money. The super will be taxed on that money at 15%. That's the most attractive sort of part of the contribution. And you can look at, so they've got caps, and you can look in the past and see, have I not met sort of the full cap in the past? And you can potentially catch up on that. So you can use that to put more money in your super moving forward. You can also potentially look at fast forwarding your contributions for up to the next 3 years. Right. So you've got scope to increase your concessional contributions if you need to, above and beyond what the yearly sort of number is. That's the first thing. Then you have what's called non-concessional contributions. And those contributions mean that that's money you would have paid tax on in your personal capacity already. And then you decide to contribute it to the super. Because you've already paid tax on it at your higher rate, the super doesn't pay tax on those, but that means you have to pay tax on that money yourself first. These are capped as well, but the cap is higher by virtue of the fact that you're not enjoying the tax benefits associated with it. So if you needed to put that $300,000 in between the concessional contribution that you can sort of bundle up and your non-concessional contribution that you might still have available to you, plus entertaining the fact that a lot of self-managed super funds have multiple members. So it might be that it's you and your partner, and I'm making no assumption here, but you could have you and your wife, in which case those caps are all double. Right. So given all of that, in many circumstances, you as a group of trustees would be able to contribute that sort of $300,000 to the super, but this is complex. So I hate to sound like a broken record, but if you are entertaining these kind of thoughts and this is things that you're thinking about, you must get professional advice to confirm or infirm whether this is sort of possible for you or not. But in principle, there are mechanisms that can allow people to do that. Yes.
And that's always our first step. When someone's looking at an SMSF, they don't already have one and they haven't got that advice yet, we always send them to, if they don't have their own financial advisor, we know some really good independent ones that we can send in.
Yeah, either way, it's crucial. And ASIC is very concerned with that. They want to make sure that people understand what they're doing and that people have the literacy to basically implement or make the most out of the freedom that's allowed to them via the SMSF, and rightly so. So it's absolutely critical. Now, once people have their SMSF, they have their advice, and they need the help with the property, this is where we can step in and offer the guidance that's property specific. But everything that relates to the prior steps needs to be covered by the right people.